No.
Good evening, everyone, and welcome to today's Witty Wednesday. Uh, as you all know, that the today's topic is Indian equity market outlook. So, uh, first of all, thank you for all of you for joining us. It's a pleasure to have such a great audience. Every week we keep this kind of a event to go ahead with different kind of a topics. So this time the topic is pretty simple. I think I would say it's a equity market outlook. So equity market once again demonstrated remarkable resilience, I would say, amid global uncertainties, evolving economic trends, and changing investment sentiments. Naturally, this raises important question: where are market headed from here? So that's the basic question everybody keeps thinking. And this is not this time, but each and every market cycles. This is the main question: where market will go ahead, and what should investors expect over the coming months, and more importantly, how should they position their portfolio in terms of any theme sector which looks attractive. To help us navigate these questions, without taking much time, I would introduce you Mr. Alok Singh. He is so uh, he is having more than 25 years kind of a experience, and he is a stellar fund performance. He has given a stellar fund performance during his career span. He is taking overall, he has the equity and fixed income investment operation for Bank of India Investment Manager. He is as a CIO. So without taking much time, I would just hand over to Alok. Alok, over to you, sir.
Thank you, Ritu, and good afternoon, everyone. If we talk of markets, currently what we are seeing is, a decent amount of volatility, right? And while some of the things which was troubling the market seems to be correcting itself, but still there is a volatility which is stemming out from various things. But if we take a step back and think why we were why we underperformed relative to global markets for last, especially 1.5 year. That is coming, that underperformance was getting stemmed from the fact that we were sitting on a very decent outperformance vis-a-vis some of the global markets. And as the normalization in the uh, uh, financial market happens, the catcher or what we call the law of averages works the best in financial markets, and that's what exactly happened. Yes, the other thing which actually uh, acted as a catalyst for that happening was the earnings side, and the earnings had come down. Now, as we see, from here on, if you guys can make me a host, maybe I can show a few uh, slides which may be useful to understand what I'm trying to say.
Yes, Uma, can you make give him access to share the screen?
So,
So I
in the meantime, yeah,
think you can.
okay. Thank you. Now, if this is the slide visible?
Yes, 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 it's visible.
So
Just make it
if you
full screen. Sorry, if you can make it full screen.
this is what I was trying to say. If you see the green part of the upper half of the chart, since 2014, we have been in a decent outperformance versus emerging market. This is a comparison between MSCI India and MSCI emerging market. So you can clearly see that there was a decent amount of outperformance which we were sitting on, despite the fact that in last 1.5 year, the emerging market index have done quite well, courtesy Korea and Taiwan. And to some extent, countries like Brazil to some extent. But despite that, if you look at, we are still sitting on a decent outperformance. So this outperformance got challenged when our earnings started moderating a bit. Uh, but the good part is that this 1.5 year of underperformance, and which you see in the chart down below, we are seeing some amount of that outperformance going away. And if you see the blue chart, a blue line is already dipped quite a lot. And if it dips another 10, 15, 10% or so, I think we will be very close to uh, the point where we have been there for last 10, 15 years. Uh, Along with this, if you look at the global side, and if as I was trying to compare the previous slide, I'm trying to compare the MSCI India versus MSCI World Index. Now here, if you look at, obviously we were chugging along quite well with the world index. But 2014, and 24 onwards, we have not done anything, whereas the world index, especially US, which is a large part in the index, have done quite well. And then there is a decent amount of underperformance which has emerged over here, and which can be seen from the chart down below in the blue color. If you look at, we have given up lot, and as a result, our relative performance is close to what we have been since 2008-9, so to say, on a very rough basis. Now, what I'm trying to say is that while our underperformance got triggered with the earnings, but that has resulted in we giving away a lot of excesses which we had on the relative basis. And now these data points are suggesting that probably the room for relative underperformance uh, is not there, right? And that can be seen on a very anecdote basis. The FII selling, though it has not become zero, but it has reduced. And if you look at for the month of July, it has been positive. So we have given away excesses. Our valuation are looking okay. If you look at, from the, whether market cap to GDP or price to book, we are looking quite attractive over there. Now, the only part which is to be sorted sees this part of this
Sir, I think your voice is not coming clear. Hello. Hello, Gopal, are you there? I mean, so your voice is not at all clear. No, I can't hear anything.
Okay, sorry for this. I think there was some bandwidth issue.
No
Um,
worries.
so what I was trying to say was that what we have seen, started with the earnings moderation, and obviously since we were sitting on a decent amount of relative outperformance, we have seen the way the market has behaved in last 1.5 roughly 2 years now. Having said that, we have given up a lot of outperformance which we were sitting on a relative basis versus an emerging market or the world index, which gives me a sense that probably we should bottom out on the relative basis from here. But for us to start our journey onward, the earnings have to fall in. Now, earnings are uh, the for earnings to start behaving the way the markets want to behave, um, it has to we have to look at the how the quarterly performance has been. So if you look at last quarter onwards, fourth quarter of last financial year, we clearly have seen the earnings uptick. Also, from in this quarter, though it is a bit early to conclude, but whatever has been declared is clearly showing a decent amount of earnings growth other than the Nifty 50 stocks. If you look at the the Nifty Next 50 or the mid cap or the small cap, whatever is declared, the growth is in high double digit. So if that trend continues, certainly with the valuation we are sitting on, which you can see on the screen, we are, if the earnings start holding on, then this valuation and our relative underperformance should make us improve from here. Having said that, if you look at the risk of the Middle Eastern crisis is still there, and I think that will continue to trouble us till it does not, I guess. But whenever this settles, I think we should do better on the relative basis. Obviously, uh, you know. um the question comes is that, which part of the market looks more attractive? Frankly speaking, if you look at ever since we have recovered from the lows of the March, primarily because of, that happened because of the Middle Eastern crisis, we are seeing that the mid and small cap have done a better job in recovery, and the earnings result of this quarter are clearly suggesting that mid and small cap are showing a better earnings growth, and hence justifying the move. Having said that, we see that structurally the market is more stable when the all the three sections of the market do well. So for market to remain structurally stable, I think the large cap should also participate. Now, in that, we believe that the banks are the only place where the ability to participate is there, because IT does not infuse any great amount of confidence. And all other also, if you look at, are either not large enough or are not seeing any additional change, so to say, to pull and do the heavy lifting. So the banks comes as a normal, as a natural candidate because of the fact that the weight is quite high in the large cap category, and they can actually do and they are very fairly priced. I think that's where our thoughts are. But yes, if I look at on from the say medium term perspective, I think mid and small cap should do better because not only the valuations are now looking better, also the the FTAs and the export push which the government is working on, that has a large bearing on mid and small cap as a category. So if you look at from the next 3-4 years perspective, I think the entire focus on manufacturing in India, and as a result, the market share, the GDP share of manufacturing moving up from say current 15% to roughly say 20%, or the FTAs getting executed and where a lot of insourcing from India happens, then the mid and small cap. So broadly, if you look at, we believe that the manufacturing side of economy will do better, and in that also the mid and small cap will be the bigger beneficiaries of the changes which are happening, and hence that should get reflected on the price side. Having said that, it is not that we are saying that the large caps will not do anything. If you go back and say 2000 post COVID till 2024, yes, mid and small cap made you more money, but it is not that the large cap did not generate any return. They did return more than trying to say it things on the relative basis. So I think broadly, there where we are in our thought process. Yes, this entire Middle Eastern crisis keep on challenging your thoughts. So we were recovering quite smoothly, thinking that the ceasefire and then probably the peace agreement will happen. Then suddenly the things have changed. I think that those things will believe that will continue to be that way. But having said that, what is it's important to note that increasingly market is learning to live with those uncertainties and moving to choose the winners and losers. Lastly, if you look at what we saw earlier in say 2021 or 23 was that the recovery of the overall economy post COVID helped everything to do well. But now that thing is behind us and we are operating in a normalized economy. And in a normalized economy, there will always be few things which will do good, few things will not do good. And hence, the market will become bottoms up. And in that scenario, stock selection will become more important than the allocation, so to say. And I think there where we remain focused and we have been able to generate decent alpha over last year also. And I think that trend of if the market remains bottoms up, I think we will continue to focus on stock selection and depending on the portfolios which we manage and the mandates around it. Lastly, there is one large discussion around inflation and the rate hikes and things like that. I think there wasn't a spike in inflation fueled by the energy prices, but I think things are now moderating. Even in US, we are seeing the inflation coming down. So we don't see an imminent risk of rate hike and then, derailing demand or things like that currently. But yes, as things normalize, as a central bank, they keep on toggling around it. But at this stage, I think we are not seeing the interest rate, and hence any demand side destruction and then its implication on equity market is not what we are visualizing right now. So yeah, broadly, that's how we are looking at things. Um, if there are any questions around this, we can take up, or if there is anything which I've missed and you want me to touch upon, I'll be happy to, talk about it if I can.
Uh, Thank you, sir. Thank you for giving us insights on the markets and what looks, going at what we can expect from the market. So, participants, if you have any questions related to markets, you can put it in the chat box and Q&A, and we are happy to take it from there. Meanwhile, just wanted to understand, as you said, that mid and small cap looks attractive at this point in time. So Q2 results is, probably we are seeing a results are, out, and upcoming season is there. What's your expectation from here on? Uh, Specifically, if we talk about the sector specific or theme specific.
Sorry, I lost you last 10 seconds. What you said? After mid and small cap, I lost you.
Yeah, so any expectation on any kind of a theme or particular sector where we are expecting a good results?
Yeah, so the thing, okay, so I mentioned that, I believe that, the uh, as we move, and I'm not talking of next 1 quarter or 2 quarter, I think the manufacturing
Yes.
side of the economy will do better than the services side, and I see the share of manufacturing and some amount of high value manufacturing moving to India for courtesy, all these FTAs and some of the government PLI policies and support, and which I think will be, some of them will be near pool of profits. So at large, I think that is one thing which should do well. And obviously, then anything and everything which is supporting it, whether it is capital goods or industrials, whichever way you should put it, even power for that matter, I think should continue to remain positive. Of course, we in our domestic side also the demand is holding on, and as the demand hold on, the discretionary side of it is more looking more attractive to us, and in that we are looking to play through auto because we believe that is one large discretionary item and still hold some aspirational value. So I think there where we are positive. So in the near term, we are positive on lending, financials, capital market names, auto, uh, capital goods, and industrials. Uh, Power, not overall energy, but power. Um Pharma is another place which we are positive. We are negative on oil refining businesses, IT. We are negative on. We are neutralish on FMCG kind of thing. We are not very positive on. Broadly, yeah, this is how we are looking at things.
Okay. One sector which is in a top like a technology. So I would like to know more about the technology. What's your view? And whether turnaround in the sector we can we expect anytime soon? Or?
See, I am not a technology guys to tell you, how the technology will evolve or how the turnaround will happen. But I think for me, one thing is important to look at it, that whatever the price which we pay to any company or any stock is nothing but the the present value of the cash flows which we are able to visualize. So the easy it is to visualize the cash flows, the higher the multiple is. The more difficult to visualize the cash flows, the lower the multiple is, right? So if you look at FMCG, we see people trading them at 40 Ps, 55 Ps, despite the fact that uh, uh, they hardly grow, right? Because the ability to visualize the cash flow uh, is uh, is easier, right?
Mm.
Or the terminal values don't just drop. Compare that with an EPC company or a contract based company where the cash flows are erratic, and as a result all of them trades at 10p, 12p, 15p, right? Now what is happening with IT is not that they will stop, cease to be in business. I'm sure they will do, and they will transform, and they may do a lot of AI related work and all. But at this juncture, it is very difficult for me to visualize the cash flows and assign what should be the shape and size of it, right? And that's what has happened with it. And that's why, with that challenge, the multiples have come down. Now, when we look at the historical multiple, we say, oh, this company used to trade at 25 P, now it is available at 15p. That itself does not make it attractive. What makes it attractive is that if the cash flows are easily visualizable, and the terminal value of the business holds on, which to my wisdom I am not able to, and hence I am underweight. Having said that, because they have, from the historical perspective, they have become cheap. They are still relevant businesses, so they may do better from here. You may see some, bounce back. But even if that happens, my view is that they will at best be a market performer. They will not be a market outperformer, right? Because typically the sectors which are market outperformers, usually people don't have any doubts around them, right? And that's how they do a secular run. So the IT at this juncture does not give me confidence of being a market outperformer. And that's where we are looking at it. Yes, you may make some money in the bounce back, but will it be superior than market? No, probably. And then I, as a fund manager, have to make a choice that do I want to make a mediocre return or an average return by taking too much of uncertainty in my books, or I will like to take a lesser amount of certainty? In that, it does not fit in, and that's where my view was.
Okay, okay, understood. Okay, so now my question on the BOI side. Um, um, if I would like to ask, like, how just for the audience understanding, because we got an opportunity to talk directly to you, so I would like to hear from the horse mouth, like, how you will describe your stock picking style. Does it more on the growth side, value side, or it's kind of a blend, and how it evolved over a period of time? Chris, if you can, help us to understand.
See, for us, we don't like to box us in any of the styles, so to say. We like to do things which are more relevant
Mm,
at the given point in time, and uh, to our understanding, right? So if we don't understand something, we don't do. But if we understand, then we have We are okay to be a growth investor. We are okay to be a value investor. And that's why if you analyze our funds and especially the funds which have ability to migrate, you will see that there is a clear migration in the style. Because nothing is static permanently or permanent in the market. Yes, for the value to be unlocked, also there has to be some amount of growth. And for you to have multi-baggers in your portfolio, you have to ride the journey from value to growth to momentum. All these stock or the sectors go through these phases. Right?
Mhm.
It is never only always growth. So it's the same part of it's part of the same life cycle. It's up to you where you want to capture it. It's very difficult. So we like to look at ideas which make sense to us on a relative basis. And then we build around that. And if that means that, our portfolio at any given point in time is more focused towards growth, so be it. And if it is more focused towards value, so be it. Momentum, typically we don't buy, but yes, some of your growth becomes momentum. So, if you have to look at the style, you will always find something what you call momentum, but you typically don't buy momentum, right? Some of your
Mhm.
portfolios become momentum stocks, right? And if they actually are becoming, then I would say that, you have a decent stock picking which you have done because if you are able to capture the entire life cycle from value to momentum, I think you have a 10 bagger probably. Otherwise, if you restrict yourself to only value or to growth or momentum any place, you may get maybe 50% return, maybe 1x, 2x max about it, and it will max out over there. Right. So I think you have to be more open, you have to be more relative to the things, and we like to work on relative basis rather than on the absolute basis. And that's where, when I was trying to explain it to you, the IT, I'm looking at relative basis. I'm not even making a call whether the IT will give me 10% return or 20% return. I'm saying that I have only 100 rupees. So which one
Mhm.
will give me the best returns? Right?
Right.
And I'll buy that. I'm not married ki nahi mere ko IT ही लेना है. If it does not fit in the stacking order, I'll not buy it.
Mm. Right.
And that's why
Okay.
if you look at our portfolios, you will find lesser overlap versus index. You will find lesser overlap versus the peer group.
Mhm. Mhm. Okay. So one fund, very interesting fund, I think BOI holds is a mid and small cap in a hybrid category, equity and debt. So just wanted to
Yes.
understand your thought on that because normally, hybrid में लोग invest करते हैं because of they are conservative. They do not want to take that kind of a risk. So why you have what thought came to combine mid and small cap in a hybrid kind of a strategy?
So let me challenge you on that part. There is nothing which says that the hybrid guy. See, the golden rule of investing is that you should stay longer, right? And if you
Hmm.
stay longer, the compounding happens. Now, your
Yes.
hybrid guys are actually the guys who stay the longest. Whom you
Hmm.
advise the hybrid. The guy who is conservative will stay for 10 years, 20 years, retirees.
Yes.
And if you stay for that long,
Hmm.
right, and you don't compound at the right pace, frankly speaking, you are doing more injustice to the client than anything, right? Because your time, just think of it, the time
Hmm.
horizon is quite long. Now,
Hmm.
obviously, in that, if I am able to give you
Hmm.
2% extra without taking much risk, I think
Hmm.
it does fantastically well. And to give you a perspective on that, if you look at the standard deviation of my index, which is mid small debt 70% and 30% is CRISIL short term index, right? This is the hybrid index which we use. The standard
Hmm.
deviation of that index is lesser than the standard deviation of Nifty 100. Okay.
Wonderful.
Now, optically, you may say, oh, you're buying mid and small cap, but what I'm giving you as a, you know, recipe, it has a lower standard deviation and it has generated higher return over the period of time. So, it is not that, see, please understand, SEBI never said that, if you buy an aggressive hybrid, then the large cap only has to be there. It is just how somehow we built around it. But, today, if you look at last 10 years of our fund, and we have completed 10 years this month, we have seen one of some of the most volatile times, and just look at the how the thing has worked. So I think it is a great compounder, and the compounder works if you stay longer, right?
Mm.
And some of these, people who come in aggressive hybrid actually are long-term investors. They are, they have money, they are just savers, they may use it at some point in time. Secondly, if you look at, most of the people don't invest in mid and small cap because they are very worried about the volatility, right?
Mm.
Even if they
Yes.
invest, the moment the volatility hits, they start getting goosebumps. And if you come in this, right, then, the debt portion takes away the volatility. You remain invested in mid and small cap. So as an advisor, if you wish to achieve a certain mid and small cap allocation in the portfolio, right, then this vehicle becomes a better thing, right?
Mm.
Now, we designed it originally in 2006, 15, 16 to, have a low volatility, which it has worked very well. At the same time, since we introduced debt in mid and small cap, we said that we will not buy large cap. So fund cannot buy large cap. Every time a
Mm.
mid cap becomes a large cap, the fund has to sell, right? Which in turn also means profit booking at regular interval, right?
Mm. Mm.
Uh, Also, if you look at the mid and small cap, are inherently more volatile than the large cap. But because I'm trying to invest through a hybrid, and the beauty of hybrid is that the cash is always there, right?
Mm.
The debt
Right.
portion, so supposing if I am even invested, say 80%, and the market corrects by 10%, suddenly my mid and small cap limit gets open. So
Mm.
while we get scared on one side that they are more volatile, but in this structure, it gives me an advantage to take advantage of the volatility. Because see, if you have invested in a mid and small cap fund, right?
Mm. Mm.
And the fund manager was invested almost 100%. The market
Okay.
corrects by 10%, your NAV fall, but that does not give fund manager the money to buy more. So he may be finding many things very attractive. He may like
Mm.
to buy, but unless somebody gives him some more money or he churns something,
Mm.
right, he will not be able to do. But in this case, I don't have to look outside. I always have money. So then it comes to your advantage. That has worked very well, because in the worst of the times in the market, you are able to still have money and buy. It is up to your conviction whether you want to. So I think these few things have worked very well, and that's why the fund has done what it has done.
Wonderful. So I am sure, I think many of us, you broke the perception of many of us, like mid and small cap is a riskier part to hold as a hybrid, or within a hybrid category. So that's the very interesting idea actually, to keep mid and small cap, as you correctly mentioned that people buy hybrid just to hold for long, and if you can compound better, then nothing like it. So thank you for, I think, for this answer. And I have one. I'll just check questions if I have many other questions. Uh, yes. Okay. So I don't have many. I don't have any questions as of now. So thank you, sir. Thank you for insights, and thank you for helping us to understand this product. And I hope the audience enjoyed this. So thank you. Thank you for your talk.